Alright, so this is the second playlist I'm doing on Schedule K2 and K3 tutorials with a new fact pattern. So if you're seeing this video first, I do have a first playlist up where we cover an example K2, K3 tutorials where we have a US LLC, but there's no effectively connected income at all. So the company itself isn't subject to any U.S. taxes. Everything just flows through to the owner. So that's an LLC where we have one disregarded entity and there's no effectively connected earnings. Now, in this example, tutorial 2, we have a very similar fact pattern, but there's one change where we've added a U.S. subsidiary entity, so there is going to be effectively connected earnings. So if you want to start with the first playlist, tutorial 1, I'll put a link to that below. Go check that one out first maybe, and then come back to this second installment. So there's 4 parts. I'm going to do 4 separate videos here in this playlist. The first one, this one, where we're going to talk briefly some of the background on K2 and K3. Obviously, if you've watched the first video, then you could probably skip over that or skip ahead just to the fact pattern. But I want to talk some background and then the fact pattern that we'll work with. And then in the next videos, we'll move into these pieces here below. So as far as what I have in front of me here, I've got the slide deck that we'll walk through. I do have a set of financial statements. So there's 3 sets of financial statements. This is the consolidated set of balance sheet and profit and loss for the company. And so I've got a separate one here. This is going to be one of our subsidiaries in Florida. So it's a Florida disregarded LLC. And then we've got a Swiss entity. So we've got a Switzerland GmbH. It's basically a corporation over there in Switzerland. And so the activities of these 2 subsidiaries are consolidated up to this holding company in Delaware. And so this is so we'll need all 3 of these in order to accurately prepare the return and the K2 and K3s. And then of course I've got the actual return itself. So we've got the 1065 partnership return. The K1s are underneath here, the K2 and the K3s for each partner. All right, so if we go back to the slides to start with here, start on the first page where, again, just talking about some high-level K2 and K3 issues here. So if you've seen my previous video, go ahead and skip over this because it's, for the most part, just the same. But what's important to remember here is that the IRS added K2 and K3, but the information has been required for years, right? This is information that's always been necessary and should be reported, but there was no prescribed form to be able to do that. So tax preparers had to just footnote a lot of these details. And the nice thing about the K2 and K3 now is we don't have to come up with our own types of footnotes. We can just use the K2 and K3s. So I think they're quite great for that reason. Now, who has to file these? There is this domestic partnership exception. So if a partnership is confident that they have no U.S. or they have no foreign activities and they have no foreign owners and they're U.S. investors, the U.S. partners in this case, the individuals or the corporations, aren't going to be claiming any foreign tax credits, so they don't need to do Form 1116 or 1118, then you don't need to do this, right? Now, of course, my recommendation is always to do these schedules no matter what, because you just never know what your partners in the entity might need in order to accurately prepare their returns. Okay, so moving on to the structure chart here. This is very similar. If you watch the first video, it looks almost exactly the same, except for we've got one change here where we have added a second subsidiary. So in the first video, what we had was this partnership LLC, and then it owned 100% of a Cayman Islands corporation. And then that Cayman Islands corporation made a disregarded entity election. What we've done here instead is we've added the US LLC to Florida LLC, and then we've also added this Swiss corporation to the bottom here. Now the distinction between this setup and what we had in the first video, if I jump down to that really quick just as a refresher, in this scenario we had a Delaware entity that owned 100% of this Cayman Islands company that was a disregarded entity. In this situation, there's no U.S. source ECI, and this is foreign source income that wasn't subject to tax at source, right? Because Cayman Islands doesn't have any income taxes. So what we had was foreign source non-ECI income flowing up to these two owners. Now, in contrast with the fact pattern we have now, we have two separate entities, right? So we still have the holding company. Now, in this case, we have a Swiss company, and in Switzerland, they do have corporate income taxes. So we have a Swiss company here, foreign source, non-ECI, that is subject to tax in the foreign country. So all of this is flowing up, this non-ECI income, and there will be foreign tax credits at this level that are passing up to the owners. And then on this side, we do have effectively connected income. So this entity is engaged in a U.S. trade or business. It generates ECI, and so we have ECI flowing up through the holding company to the non-resident partner and the U.S. tax resident partner. Okay, so now let's look at the fact pattern in a bit more detail here. So we got some information before we really jump into the return itself. So the company, this holding company, formed in Delaware in March 2021, and it has two owners, right? So we have John and Jane. John's a U.S. citizen, and he lives in the Cayman Islands, while Jane is a Bermuda citizen, and she's a resident of Bermuda. Now, John is taxed as an individual and does not plan to make his Section 962 election to be taxed as a C Corp. That's important to note because if John were going to make that election, it might require us to prepare some additional schedules that would only be relevant for C corporations. But in this case, we don't have to do that because he's kind of, in an effort to make the example a little more simpler, we're just going to assume that he's not doing that. Okay, so the first subsidiary here, Fake Store GmbH, operates a convenience store in Zug, Switzerland. The store is a convenience store, so it sells a variety of products. And the entity filed an 8832 election to be taxed as a DRE. Now that's important because the GmbH is by default a corporation for U.S. tax purposes. So if we didn't make this DRE election, we would have a CFC or controlled foreign corporation. So we'd be preparing 5471s, we'd have subpart F income or guilty income potentially. So what we've done is we made the DRE election so everything just flows up as a disregarded entity. Now in Switzerland, the entity employs 5 people on a full-time basis. And the Swiss entity operates independently of the entity in the U.S., right? So in other words, the Delaware company is just a holding company. The LLC in the U.S., Fake Store LLC in Florida, runs its own thing. And then you have the Switzerland entity doing its own thing as well. Okay, so the Fake Store entity here, LLC in Florida, again, another convenience store here in Orlando, offers a number of different products for sale, what you normally see in a convenience store. And by default, the entity is a disregarded entity because it's a single member LLC, so we don't have to make any actual elections. And that Florida entity employs three people on a full-time basis. Okay, so now the Florida entity and the Swiss entity and the holding company, so all 3 of these entities here do keep separate books and records for accounting and tax purposes, which is fine. That's also highly recommended and generally necessary. And that's because the Swiss entity has to file its own taxes in Switzerland. The Florida entity doesn't necessarily have to file anything because it's a disregarded entity, but it is always a good idea to try to keep separate books and records for all of your entities just because it makes things cleaner and it further supports this idea that they are being operated independently of one another. Okay, now the last point here on this line before we move on to the next, the Switzerland entity is going to be treated as a foreign branch of a U.S. person, so we'll have to do an 8858 to report those activities, and then of course the K-2 and K-3s should be updated to reflect that this is not only a foreign company but a foreign branch operation of that U.S. person, right? The U.S. person being the Delaware holding company. Now, this next slide, we continue the fact pattern that we're going to be working with here and highlight some of the details of the return and the K2, K3. So, again, just basics here. The holding company, the Delaware entity, is a partnership, so it's going to be filing in 1065. And again, the company earns both U.S. source ECI through its Florida entity, and then it has foreign or non-U.S. source foreign branch category income through that Swiss company. And what's important here to remember is the partnership entity itself really is just a holding company. There's nothing going on there. All the activities are being conducted at the subsidiary level. So the Florida entity is certainly engaged in a U.S. trade or business because it has a physical location within the U.S. Its products are sold to customers in the U.S. It has employees in the U.S. So we have a U.S. trade or business at this level. However, at the Swiss entity level, that is not engaged in a U.S. trade or business, right? So all the activities are conducted in Switzerland, and the owners of the holding company, LLC, do not live and work in the United States. Again, that's a very important thing to remember. If we look at the holding company here, the owners that are managing this business remotely, one lives in the Cayman Islands and the other lives in Bermuda. Okay, so they're not based in the U.S. when they're running these companies. Now, again, as I highlighted earlier, the Florida LLC and the Swiss entity don't interact with one another at all. They have separate employees, separate contractual relationships with their suppliers. They have separate bank accounts, right? The only thing that's in common is just the common ownership with the Delaware holding company. Now, the allocations of the U.S. effectively connected income to that non-U.S. partner will be subject to withholding taxes, right? So when a non-resident is engaged in U.S. trade or business and has an allocation of ECI, that ECI is subject to withholding, right? So it's paid and reported on Form 8804, and the portion that was allocated to that non-resident partner gets reported on their individual 8805. Now, we have US ECI that's being allocated to John as a US citizen, but because he's a US tax resident, John isn't subject to withholding tax, right? Because he has to file his tax return every year, report the income no matter what. And so for that reason, what we'll see when we dive into the return details is that, okay, we have U.S. effectively connected income from that Florida entity, but because it's split between a non-resident and a U.S. tax resident, only the non-resident is subject to withholding tax on their allocable share. All right. Now, the Swiss entity is, again, it's treated as a corporation for Swiss tax purposes. So it's paying corporate income taxes in Switzerland, right? So the tax rate, the effective rate that we'll have for 2021 is 9.8%. But again, remember, the entity is disregarded for federal tax purposes. And that's because after we formed the entity, we filed this 8832 election to make it a DRE. Now, what we'll see here, and again, I'm going to go through the numbers on the K-2, K-3, and the 1065, so we're not just looking at them on the screen here, but what we're going to see is that the net ECI allocation to Jane, $43,716, is going to be subject to that maximum withholding rate of 37%, and that's because Jane is an individual, right? So 37% for allocations to individuals, 21% for allocations to foreign corporations, if those were the partners in the entity. All right, so she's going to be liable for, the partnership is going to withhold $16,175. Now, because the partnership knows that they're going to have to withhold and pay some tax to the IRS for these allocations, what they did, and this is very common, is they made an estimated payment of $20,000 towards that balance before the end of the year. Now, the $20,000 was their estimate of what might be enough tax to cover the ECI allocation to John. And so what partnerships will do is after they make this estimates, they do true-up calculations and they figure out, okay, how much ECTI was actually allocated to the non-resident. And so after they actually figured out what the net amount owed to her was, so she was going to get $43,716 of ECTI at $16,175. When they file their 8804, they can claim the $20,000 estimated payment. They would note that $16,175 was the actual balance due, so then the partnership gets a refund of $38.25. All right, and so again, I'll show you on the financial statements how we record that, how all that's reported on the 8804. Now, when a partnership withholds taxes and makes those payments to the IRS, that is treated as a deemed distribution to Jane. So Jane gets a recording on the CAP schedule and on her Schedule K-1. The withholding tax for U.S. taxes paid on her behalf by the U.S. partnership is treated as a distribution. And so we'll see that on line 19A of the K-1 for Jane. Now, the Swiss entity paid $11,600 in taxes. So remember, we have a Swiss corporation. It's engaged in business within the country of Switzerland, so they owe Swiss corporate income taxes. So they paid $11,600 in taxes on their earnings. And because this is a DRE, right, everything is flowing up to the partners. And so what we're going to see is the $11,600 is being allocated equally to each of the partners as a foreign tax credit. Okay. Now, lastly, I just want to summarize the parts where we're going to be completing here and then what will not be completed. So K2 and K3 parts that we need to do based on this fact pattern. So if you look at the K2, you'll see that there's a ton of different parts, right? But obviously not all of them might be required, right? It really depends on your company's facts and circumstances. So the parts that we will be doing, parts 1, 2, 3, and 10. So 2 and 3 are where we're going to see a lot of activity, right? This has to do with gross income and gross expenses, U.S. versus foreign source, and how we allocate those amounts and foreign tax credits. And then part 10 is very important for Jane in particular, because this is where we show what portions of the income are effectively connected income versus non-effectively connected income, right? And then the rest of these parts here I have listed as we're not going to be completing, and then the reason why. So if you want to pause this and go through kind of the reasonings in a little more detail, that's fine. But generally speaking, these are not being completed again because there is something about our structure that just does not apply to these parts. So, for example, right, if we look at like Part 6 covers Subpart F and guilty inclusions. Well, because our Swiss entity elected to be a disregarded entity and it's not a CFC, we can't have Subpart F income and we can't have guilty, right? Because those are provisions that only apply to controlled foreign corporations. So that's why this section is left blank. It's a moot point. And the same applies to all these other parts, right? I mean, if we had, we're not a covered partnership, right? Because we don't have any kind of strange financial products or dividend equivalent payments. The partnerships interest in foreign corp, right? We don't have foreign corporations here. We legally do, right? We have subsidiary foreign corps, but again, because they're disregarded entities, we don't have to worry about deemed paid foreign tax credits and the like. So that's why these parts are not being completed. I do have an example that'll be posting that'll cover all of these. So I will try to highlight when the circumstances would apply, but for now they just don't, not in this fact pattern. All right, so that covers it for this first video. Now we've covered the background on the K2 and K3, the fact pattern. Let's move into the second video where we address the fact pattern again and then look at how these numbers are actually falling on the 1065, the initial 1065, and then we'll jump into how the numbers again flow through on the K2 and K3s.